You'd think renting a piece of equipment would be simple, right? It's just an expense you pay every month. But in the world of accounting, it's not always that straightforward. You see, some rental agreements are actually considered formal leases, and they can have a huge impact on a company's balance sheet. In this explainer, we're going to break down exactly how you can tell the difference and how to get that lease recorded correctly.
So here's our game plan. First, we'll figure out what actually makes a lease a lease. Then we'll jump into the official 3-part test and use it in a real-world case study. After that, we'll get into the numbers, how to measure and record the lease, again with a hands-on example. And to wrap it all up, we'll summarize the key things you need to add to your accounting toolkit. Sound good? Let's get into it.
Okay, so the very first thing you've got to figure out is when a rental agreement is more than just a simple expense. And trust me, this is a big deal. Why? Because a formal lease means a company has to add a brand new asset and a brand new liability to its financial statements. That can totally change things like financial ratios and debt covenants. It's pretty important stuff.
So, does this mean every single contract that involves renting something is a lease for accounting purposes? Well, the short answer is nope. To make sure everyone's on the same page, accounting standards have given us a really specific set of rules to follow. Think of it like a checklist to make sure we're all playing the same game.
So how do we solve this puzzle? Well, accountants have this great tool, a simple 3-part test. If a contract passes all 3 parts, boom, it's a lease. But if it fails even one part, it's not. And the whole test really boils down to one core idea: control. Does the company using the asset actually have control over it?
Let's break this down. Step 1. There has to be a specific identified asset. We're talking about this machine, not just any machine. Step 2, the person or company using it has to get pretty much all of the economic benefits from it. And step 3, the user has to have the right to say how that asset is used. All 3 of these have to be a yes.
Okay, theory is great and all, but let's see how this thing actually works in practice. We're going to apply our 3-part test to a case study. Now would be a great time to pause and maybe jot down these details because we're going to refer back to them.
So here's our scenario. We have Champion Leasing Corp. They're the lessor, and they're running a specialized piece of equipment to New Electrical Corp., our lessee. Now, this equipment has a total useful life of 10 years, but the lease agreement is for 7 of those years. And New Electrical is going to pay $32,000 every year. Okay, got the facts? Let's apply our test.
First up, the identification test. Is there a specific asset here? The answer is a clear yes. The contract doesn't just say a piece of equipment, it says a specialized piece of equipment. That's the key. It means Champion Leasing can't just swap it out for some other machine whenever they feel like it. It's this one. So check. Step 1 passes.
All right, on to test number 2, economic benefits. Does New Electrical Corp get the main rewards from using this machine? Absolutely, yes. For that entire 7-year term, they have the exclusive right to use it. That means all the products it makes, all the profit it generates, all those advantages go directly to them. So, check. Step 2 passes, 2. And for the final piece of the puzzle, the 3rd test, the right to direct use. Does New Electrical get to decide how and when this equipment is operated? You bet they do. For all 7 years, they are in the driver's seat. So, since we got a yes on all 3 tests, identification, benefits, and direction, we can say for sure, this contract contains a lease.
Okay, so we've officially identified a lease. Awesome. But now what? We can't just stick the contract in a filing cabinet. We have to get it on the books, on the balance sheet. And that means we need to calculate its value, which is something called the right of use asset.
So what on earth is a right of use, or ROU, asset? Well, it's pretty much exactly what it sounds like. It's an asset that represents your right to use that piece of equipment or that building or whatever it is you're leasing for the entire lease term. It's the financial value of that control we just worked so hard to identify.
Let's get our hands dirty with another example. This time, we're going to focus on the calculation and the all-important journal entry. And again, this should be a really good spot to pause and write down the details of this next case.
So in our second case, we've got Ragnacorp leasing some equipment from Toric Inc. The key facts are, it's a 6-year lease with payments of $40,000 a year. Now, the initial present value of all those payments, which is our starting lease liability, is already calculated for us at $204,530. But wait, there's more. Ragnar also had to pay a finder's fee, some installation costs, and they have to plan for the cost of dismantling the equipment at the end. All of these pieces are going to be part of our calculation.
Okay, so how do we get to our final ROU asset value? Let's take it step by step. We always start with the initial measurement of the lease liability. That's the $204,530. But we don't stop there. We have to add any initial direct costs. Think of these as costs you wouldn't have had if you didn't sign the lease. In this case, that's the $7,000 finder's fee and the $10,000 for installation. Finally, we add the present value of what we think it'll cost to dismantle the equipment later, which is $7,155. Add all that up, and we get our grand total.
And there it is, $228,685. It's so important to remember this isn't just the sum of the lease payments. This number represents the total cost that Ragna Corp had to sink in to get this asset up and running and ready for use. This is the value that goes on the balance sheet as the right-of-use asset.
Now for the fun part, the journal entry. Let's walk through this slowly so it makes perfect sense. First, we debit the right-of-use asset for that total value we just calculated, $228,685. An asset goes up, so we debit it. Easy enough. Now we need credits to make it balance. We credit cash for all the money we've already paid out. That's the first lease payment of $40,000, plus the $7,000 finder's fee, plus the $10,000 for installation. 40 plus 7 plus 10 gives us a total cash credit of $57,000. Next, we credit a new liability for the future dismantling costs. We call this a decommissioning obligation for $7,155. Now for the last piece of the puzzle, the lease liability. We credit it for $164,530. Now where did that number come from? Well, we started with an initial liability of $204,530. But we immediately made that first cash payment of $40,000, which reduces it. So $204,530 minus $40,000 gives us $164,530. And just like that, our debits and credits are perfectly in balance.
Okay, that was a lot to take in, so let's boil it all down to the essentials. What are the key things you absolutely need to remember from all this? Let's summarize the main points to add to your accounting toolkit.
First, always start with the three-part test. That's how you know if you're even dealing with a lease in the first place. Remember, it's all about control. Second, the right-of-use asset isn't just one number. It's the lease liability plus any direct costs to get it ready, plus any future costs you're on the hook for. And finally, that initial journal entry is what makes it all official. It puts the asset on the books and correctly lines up all the liabilities and cash you've paid.
We did it. We've successfully identified a lease, calculated its value, and recorded it on the balance sheet. But, getting it on the books is really just the beginning of its story. This brings us to the next big question. Now that you have this asset, how do you account for using it up over time? In other words, how is a lease asset depreciated? That's the next step in the journey.